Nilesh, good morning. Thank you for joining us. My first question is simple and straightforward. How should one cope with this sell-off? You can get into endless reasons, Nilesh, why markets have fallen, what is the impact of coronavirus, this is algorithm trading. But the bottom line is that how does one manage, deal, and cope up with this kind of a sell-off?
So one, we have to recognize that we are all emotional people. We do get impacted by the drop in prices, even though we believe it is temporary. And in such kind of emotional stress, we should go to our advisor who can handhold us, who can show us 2008 carnage and say that, look, the same thing happened in October 2008, but because you remain invested, you made money. He could also show 2013 taper tantrum and show that, look, the same thing happened then, but you made money if you stay invested. So most important thing is to recognize our emotional situation, our greed, our fear, and then seek right advice from our distributor, our advisor, who can handhold us during this tough time.
Nilesh, now let's talk about what Indian government has done so far, or what we heard from Reserve Bank of India. You know, while I'm a big votary of how Reserve Bank of India took care of Yes Bank and how government sorted the Yes Bank mess, yesterday in my book, the press conference was nothing short of just a standard communication when every central banker is showing urgency and aggressiveness. Do you think that was missing yesterday?
It's always easy to judge a person from outside. But when you are at the driver's seat, you have to take a call depending upon how the things are turning around. Now, to a pessimist, one can say that, look, Reserve Bank did not cut the rates like other countries. On the other hand, if you're optimist, you will say that Reserve Bank did provide another 1 lakh crore of liquidity, which is equivalent to quantitative easing. If you are realist, you will say that, look, here is a message from Reserve Bank of India that we are watching situation and we will take all corrective action with all appropriate tools in our hands. So my guess is that let's respect what Reserve Bank of India is doing. They have more access to data than we have, and they will take right decision. Let's not forget that in 2008, the same Reserve Bank of India was working overnight. They were cutting interest rates, they were providing liquidity. And from mutual fund industry, I can vouch that even though under the law, RBI was not supposed to provide financing to mutual fund, it took them just 24 hours to find a refinancing line, which was passed via the banking system to mutual funds, and it resulted in calming the markets. So if the push comes to shove, in 2008, RBI delivered. It's the same team, same management, same institution. I doubt if in 2020 they won't be able to deliver. I'm quite optimistic that they will take right steps at right time.
But Nilesh, even if the MPC does choose to bring down rates in its April policy, which the RBI governor did not really rule out in his press conference yesterday, but do you think that would really do the trick? Or would you say that what one requires right now is a more targeted economic stimulus to try and churn up the economy per se? So would the government also have to step in, is my question.
So till yesterday, I checked with one of the largest cement company in India, and they said till yesterday there was no disturbance in their demand of cement all over the country, except some parts of Kerala. Cement consumption, cement demand was normal. Now, we are really trying to factor in the future. We are not talking about the past. And the experience of shutting down activity, locking down city, shutting down the whole country clearly varies from sector to sector. There will be sectors like aviation, tourism, travel, which will come under severe pressure. There will be maybe sectors like pharma and medicine, which will actually benefit from this situation. Now, within this, the central bank, the government, and the people all will have to come together. At central bank level, cutting interest rates, providing liquidity, ensuring credit flow continues to move into the economy will be crucial. They'll have to think of innovative steps like LTRO and like twist. maybe something equivalent to TARP also. On the government side, they'll have to ensure that one, the law and order situation continues to remain, and as much containment as possible happens for this virus. So it will be like 2008, where regulator, government, and market will have to come together to give quick responses as the situation evolves.
Sure. So, as an investor, Nilesh, what is the right approach? I know, in retrospect, we say there was a 2008, and look what followed 10 years after, drawing back even to 1987, because many are correlating now that the Dow crash yesterday to the 1987 crash. We all know that, but how is it that you get yourself down to buying this fear? And do you buy this fear just yet? Or do you wait for the first signs of recovery to come in? It's okay if you actually do not catch the bottom. I mean, who gets to time the market right anyway?
So undoubtedly, one will have to take a call depending upon what kind of asset allocation he has. Let's assume, and I'm just saying for the sake of saying, let's just assume that there is one gentleman who wants to go to 50-50 in equity, and right now, because of market correction and under investment, he's just at 20%. Now for him, there is far more leeway to invest in this market because he needs to put 30% of his wealth into equities. This is a great time to buy. We don't know where the bottom is, so don't put all the money at one go, but try to invest on a regular basis over next 2-3 months. Hopefully you will average yourself into the market. On the other end, there is someone, let's say, who also wants 50-50 allocation, but he is actually 70% into equity. Now, this is a far higher allocation than he can afford. Maybe he is leveraged, maybe he has taken futures and options position. He should be focusing on cutting down his 20% despite great valuations to buy, because you are already overexposed to more than you can afford. So one will have to take a call depending upon what is your risk appetite, what is your investment objective, and what is your asset allocation. If you are overweight, do not increase risk in this point of time. If you are underweight, try to embrace risk, but in a calibrated manner, gradual manner. Don't jump in at one go in this market, because we never know where the bottom is. The market will first need medical solution to this problem, and then the financial recovery will happen.
Enough. That is the advice that investors need to heed to at a time like this, not to go all in, but definitely to try and nibble into the markets at these lucrative and mouth-watering valuations. So Nilesh, if we were to stretch that a bit further, where is it that you would believe that there is this opportunity for someone who has a fairly decent risk appetite?
As of today, fortunately, most parts of market is available at below average valuation. I yesterday did an analysis that from Jan 18 level, Nifty is down about 12%, mid cap is down about 32%, and small cap index is down about 51%. Now, with 51% correction, definitely small caps have become attractive. With 32% correction, mid caps have become attractive. Large caps, there might be few stocks which are not as attractive because their valuations are still above average, but rest of the large caps have also become below average valuation. So you have a choice of investment across most of the large caps, most of the mid caps, and most of the small caps. When you are investing in small and mid cap, do remember that they will be still more volatile. There will be high ups and downs in those portfolios, in those stocks. But if you can grab or nibble at every level, the small and mid cap looks, from a valuation point of view, far more attractive.
Right. What about the risk then, Nilesh, when it comes to earnings revisions? Because if there are going to be companies that will be reeling hard from the impact of COVID-19, as you spoke of, some of those travel, airline companies as well. But where is it that you see the maximum risk of earnings erosion?
So it doesn't require too much of thinking to figure out that aviation will be the highest hit industry. Then it could be related to travel and tourism. Fortunately for us, both of them are not very large part of the market cap, but it does employ significantly large portion of people. Then next depends upon what kind of shutdown of activity happens. If a city like Mumbai shuts down, then maybe the impact will be far more on services industry than manufacturing industry. But if we see clusters of industrial activity like Mumbai Pune road or Mumbai Ahmedabad side, if that they start shutting down, then the impact will be more on industrial activity. As I mentioned earlier, when we spoke with a large cement company, till yesterday they were seeing normal growth in demand, except for some small parts of India. So far we have survived the negative effect of COVID-19. It doesn't mean that future will be same. Future will depend upon what kind of evolution happens on COVID-19 risk. But till today, by and large, industrial activity, service activity has remained reasonably okay. There is immediate impact on travel and tourism and aviation, but the rest of the industrial and services activity, by and large, has remained the same.
Nilesh, just to request you to stay on with us. We're just about a minute away from the market opening this Tuesday morning. And the SGX Nifty has been indicating a positive tick, but do remember, despite that rate cut by the US Fed, last night it was just a bloodbath across the US markets. In fact, as Aisha was saying, likening it to the 1987 crack, you had Wall Street collapse to its worst rout, and there continue to remain the concerns from the blow of the coronavirus outbreak. We did see gashes as much as in double digits for most of the headline indices across Wall Street. You had Donald Trump as well alluding to the fact that this could stretch up until August and that we are in for a recession. You also have the Asian markets this morning looking rather bleak for the most part, and it looks like we will be taking on those cues when we open for trade. Yesterday, it was a bit of a disappointment from the Reserve Bank, given that expectations were rife that we would see some sort of initiation of a rate cut being taken. So that too is coming in as quite a disappointment. And you've also got the backdrop of crude oil prices tumbling, Brent sliding sub $30 per barrel as we have seen the demand completely evaporating. So how are we starting off for trade this morning? Well, much like the SGX Nifty actually was indicating, it is a positive start. One really wonders whether this will sustain, though. At 9,300 and thereabouts on the index, it's a 1% uptick for the frontline indices. Pull up the broader markets as well. And the advanced decline ratio as of now seems to be favoring the gaining side. For the mid and the small caps too, we've gotten off with a positive rate, up by about 0.7%. It's barring media, you've got metals, PSUs, energy, as well as pharma and PSCs, which are holding out quite smartly. And in fact, it's a day that started off in the green, and Aisha, a lot of frontliners taking the lead.
Yeah, they are, but we're going to give these rates a skip. Let's only hope and keep our fingers crossed that once the normal trading kicks in, these rates are replicated and perhaps built on too. But Nilesh, getting back to you, you were talking about the usual suspects where you would see an earnings hit, and that's obviously going to be the travel tourism related industries. But overall, what is the market pegging in? I mean, is the market trying to price in maybe 2 quarters of an earnings lag now, as opposed to those green shoots just about emerging in Q3?
I don't think so. Market today is able to forecast future as convincingly as one would like it to be. Situation is evolving on a daily basis. Undoubtedly, we all believe that there will be appropriate policy responses. There are certain benefits which are coming to Indian economy. For example, lower oil prices will save billions of dollars to Indian consumer, India Inc. and Indian government. Trade deficit with China will come down as global trades have slowed down and Chinese dumping into India will be curtailed. There will be higher liquidity and lower interest rates to support economy, and the benefit of that should start coming once this crisis comes under control. So there are some silver lining to this dark clouds. But as of today, does market have a conviction to forecast future? My answer is no. They will have to factor in the situation as it evolves over next couple of weeks.
Nilesh, how does one really figure out a simple fact, which is that how much of a contraction in earnings and talk of a view of a global recession is in the price, which is that have markets preempted a recession and corrected, and when the bad news will start coming out along with Q1 numbers, along with Q2 numbers, will markets not react to that?
Undoubtedly, market is forecasting future, and while it is not able to visualize future as correctly as it should, clearly they have factored in many negatives. At this prices, at this valuation, undoubtedly much lower earnings growth or negative earnings growth in many companies have been factored in. But as I mentioned, you'll have to continue to see how situation evolves. For every deterioration, there will be some policy response. And then how does that commingle and how do they deliver in future? So my guess is that by past experience, the bottom of the market is at the peak of the crisis, because that's where people become most pessimistic, they discount maximum negativity. Slowly, situation starts evolving for better, and that's where market starts moving up. While the negative news continue to come, market continues to rise because it has already factored in the worst situation. So by and large, the thumb rule is that at the peak of the crisis, bottom of the market is made.
All right, Nilesh, really appreciate your time. Highly obliged that you took time to join us. Markets, meanwhile, we off to a good start. The real, side pocket which seems to be showing signs of action and traction are some of those labs, of which, when I say pathology, stroke, healthcare companies, where now the coronavirus testing could be made official, at least in some of the authorized labs. And the reason why they're going higher is because markets feel that this is going to be more business for them.